Well, the Disney quarterly reports of their fourth fiscal quarter and the close of their 2021 fiscal year, now entering fiscal year 2022 for Disney, came out Wednesday afternoon. And, well, we got some news on Disney Plus subscribers, some news that Bob Chapek just a few weeks ago gave us a bit of a premonition on, and they came to fruition, lo and behold. Big surprise there. And as you can see, the markets didn't react terribly well to this. However, I think there's more to the story. Stick around. I know you guys always come here for a bit of a sobering opinion on this. Stay tuned. Here we go. Renegade Online. Well, welcome back. Another great day here at Valiant Renegade. Appreciate you all being here. This channel is growing like a weed. We have been on YouTube now for just a little over, I think, 10 months at this point. Started around February 1st, and here we are just in the early to mid part of November, and we are approaching 2,000 subs. It's amazing. Absolutely astonishing growth. Could not have done it without you guys and girls. I appreciate you all being here. Make sure you hit that subscribe button if you have not already and you've been enjoying this channel content. I know there's about 60 to 70% of you out here watching these videos that aren't yet subscribed. So hoping this will be the day you do that. Make sure you hit the like button, the notification bell, so you can find out when we release new videos as soon as they come out, if YouTube cooperates with that. And also make sure you share this sucker out on the social medias like Twitter, Facebook, any of those. It's fine. All of them. All the above. All the above. So welcome aboard. And we have this today. We have the fourth quarter fiscal year earnings for Disney. But before we get into this, and this is a fourth, again, fiscal quarter. This is not a calendar quarter. I know we just had the end of the third calendar quarter on September 30th, but just so you understand, that is the close of Disney's fiscal year. Their fiscal years run from October 1st to September 30th. Not uncommon for many large publicly traded companies that operate in that fashion, just so you understand. So if you hear me say fourth quarter or the end of the year for Disney, you know I'm talking about their fiscal year, not the calendar year. All right, so just to go back to this real quickly, this was today's market. This is the day after. Disney obviously released their earnings results Wednesday afternoon. I am recording this Thursday evening, so about 24 hours after the release of this. I did read the data yesterday. I did listen to the publicly available call, investors' call, where they did the reports with CEO Bob Chapek and a few others involved. So as you can see, Disney dropped about $12 today, or 7%. I'm not going to get into the intricacies of stock market stuff. That's not what we do here. I'm just showing you this is Yahoo Finance. This is a publicly available page. Anybody that wants to go see and look at different stocks and learn about this stuff, you can go here. Nothing secret. But this was the reaction today, which was to be expected considering some of the news that they delivered. However, I didn't consider the news that they delivered to be anything terribly surprising. If I had to guess my personal opinion, based in some professional experience for the last 20 years, I would say that this stock price is going to be relatively short-lived, and we'll see it probably come right back short of anything else over the next several months to where it was. So why do people react this way? Well, as we've talked about before, and again, we don't do financial advice or anything like this on this channel. This is only talking about this because we do talk about Hollywood entertainment news. We do talk about pop culture news through the lens of business and finance, right? To kind of make it all make sense to the average pop culture fan out there is why companies do the things they do and why companies react the way that they do. And that seems to be real popular with you folks because I keep getting comments on this. I keep getting compliments, I should say, that this channel does things very differently than most other channels that cover pop culture news because we do kind of take a more financial, business, mathematical approach to why things are the way they are, although we do still love to comment on the pop culture aspects of it from time to time. But this is our bread and butter right here. So let's take a look at this. So Disney stock had a funky reaction today. It's not the first time, won't be the last. It's really nothing to jump up and down and get alarmed about, at least not in my opinion. These are short-term jitters. But for those of you that were asking, they say, oh, how do you listen to these calls? How do you get these reports? It's a publicly traded company, folks. All you have to do is go right here to the WaltDisneyCompany.com website. and you can go to their investor relations page. And if you scroll down, you'll see all of their quarterly reports that they file with the SEC. That's the Security and Exchange Commission. And you can see right here Disney's full fiscal year final quarter 4 earnings results webcast. That's what they did yesterday. And when you click on that, it'll take you right here, and you can get all that information. And if you wanted to go back and wanted to listen to the live call that they had, you can do that with all the Q&A sessions. I believe that's still publicly available to anybody. You don't have to be a Disney stockholder to listen to this, and that goes the same again with any publicly traded company out there. So let's talk about a few things. Why did the Disney price today have this kind of reaction? Well, as we talk about on this channel, we don't talk about stocks, we don't talk about investing, but as it relates to streaming content, as it relates to the streaming wars, as it relates to Disney Plus in this case, because that's part of the pop culture Hollywood entertainment venue, this is what we want to get into. So as it has been since really Netflix has become a big thing in the last several years, everybody loves to look at these days and focus in on things like subscribers and subscriber growth, more importantly. And when people don't see the kind of subscriber growth that is either being sustained or growing or stuff like this, it tends to have these days more amplified magnitude when it comes to what happens to the price of a company's stock the next day. That being said, and I did a video on this. You can go back in the video history and find this. And in fact, I'll post a link to this below this video, where I spoke about a month, maybe 2 months ago now, somewhere in that time frame, on a comment or a series of comments that Bob Chapek had made publicly regarding his expectations for what Disney Plus subscriber growth would look like in the 4th fiscal quarter, which this report here is discussing. This is the official report from yesterday, but he gave some guidance on this, some forward-looking guidance in the last month or two, what we could expect. And the reason was basically to soften some expectations. So let's back up for a second. Disney Plus Day is Friday, and this is the 2-year anniversary of the launch of Disney Plus. This is where Bob Chapek, the studio heads of Marvel and Lucasfilm and Hulu and FX and Pixar and all these guys are going to go out there and they're going to talk about the upcoming slate of content that is going to be released pretty much over the next 12 months, in some cases projecting further out than that, to talk about what is coming. Well, one of the things that Chapek said on the phone call yesterday was that, and I thought he was absolutely right on this point, was that having a robust content library on in this case Disney Plus is what keeps subscribers subscribed, keeps that revenue coming in every month. But it's new content that brings in the new subs. And of course, there hasn't really been a whole lot of new content on Disney Plus in the last year. In fact, there hasn't been a whole lot of new content in television and movies at all in the last year because everything was shut down for 12 months, especially in terms of production. So all of that stuff is backlogged. And things like we're seeing now with slowing growth on Disney Plus, along with probably a lot of other places, like we saw Netflix report recently, they had lost some subscribers. Their growth has basically stagnated. A lot of this is across the board because it's due to a lack of new content sucking people in. Of course, Netflix is also fairly mature. There's not a whole lot of room for them to grow anymore at this point with 200 some odd million subscribers, unless they expand into new territories, which Disney is doing. We'll get to that in a minute. But what Bob Chapek was warning about a month or two ago was that the growth for Disney Plus is not going to be linear, as it would not be anywhere. Meaning that if Disney comes out with a series of projections saying that they expect Disney Plus to reach 250 million, I think was the number that they gave about 2 years ago, growing to 250 million subs by X date, you cannot then automatically assume that each and every fiscal quarter that they report on is going to have a same equal fraction or portion of that subscriber growth like clockwork coming in at the same rate of growth. It's not. Of course, Disney Plus had a massive amount of growth over the last year in 2020, especially because of the lockdowns. People were staying at home. And the projections that they had for growth in their first year of Disney Plus were wildly exceeded. I think maybe 2 to 1, if I'm not mistaken. It was a substantially more subscribers that they got in that first year than they had expected. So now we are seeing the lagging factors of no new shows coming on, or very few, no production that has been done over the last year to keep that pipeline healthy and full, just as it has been for any other streaming service out there, any other TV channel for that matter. It's been very difficult. So, point being is that Disney Plus is going to be expanding into quite a few new territories and markets in the next 12 months, in this next fiscal year that they're currently in right now, fiscal year 2022. Bob Chapek alluded to about 50, maybe 60 other new countries that they're moving into, with over 300 new pieces of programming content that they're developing, many of them being specific towards the region or the country that they're going into. So it's not like we're going to see 300 new shows on Disney Plus, Hulu, and ESPN Plus right here in the States. We're going to see some of them here, and then we're not going to see many of them here because many of them are specifically geared towards, say, Hotstar in India, or they may be specifically geared towards Middle Eastern countries that they're opening up in the next few months. Friday, on Disney Plus Day, the same launch of Disney Plus Day, they're also launching the service in 3 new countries. They're launching in South Korea, they're launching in Hong Kong, they're launching in Taiwan. So those territories, those countries, those markets are going to have the Disney Plus service. And the nice thing with those markets are that they have a similar subscription fee when you convert it back to US dollars as we pay here in the States. Some of the problem with Disney Plus, as we discussed here in the past, and also friends of mine like Culture Casino talk about all the time, average revenue per user, ARPU or RPU, a revenue per user, with Disney has been on a steady decline. And in fact, it went down again this quarter. Went from $4.16 per user per Disney Plus subscriber down to $4.12. Now, why is that? How is it you're paying $8.99 a month and Disney is saying their average gross revenue per user is less than half of that? Well, it's very simple. It's because roughly 35% or so, according to, I believe, what they said on the call, if I didn't misunderstand it, roughly 35% or so of their total Disney Plus subscribership is now in Hotstar India, which Hotstar is the service that they basically bought out to merge with their Disney Plus service in India. India, Hotstar, those subscribers that they have on the books pay roughly 70 cents a month for the entry-level Disney Plus package, whereas, of course, here we're paying about $8 to $9 a month. So they're paying literally a tenth, a fraction of what we're paying, less than a tenth. They pay basically over the course of an entire year what we pay for 1 month of subscription here in Disney Plus. Now, that also doesn't mean that they have the exact same content that we do either. It's a very different slate of content over there that we have here. Of course, they do have some of the same things, but they have some things we don't have. We have things that they don't have, vice versa. So that's been part of Disney's problem, is the expansion that they've had on Disney Plus, especially in the last 6 months, 9 months, the last 3 quarters, I'd say, has been in these lower revenue yielding international markets like India. But like I said, with Taiwan, with Hong Kong, with South Korea, Japan, I think is already online or coming online soon. Those are markets that have much higher revenues per user. They're much more on par, like the UK or somebody like that, with the US. So those are good markets that Disney wants to be in. Here's the thing. This is the bottom line with this, is that what you need to understand is that as time goes on, and Disney, obviously, Chapek is being smart about this. He's not doing this yet. He is waiting until the content pipeline explodes, which, according to him and according to Disney, should be within the next 12 months. And when a lot of that content that has been furloughed, thanks to pandemic lockdowns, not been able to be produced, is going to be hitting the airwaves, or in this case, the streaming waves, for Disney+. That's when not only they're going to see a lot of subscription growth come in, they're going to hang on to or create a bigger bond with their audiences that they do have globally on Disney+. But more importantly, once that pipeline is steady and the flow of that content is consistent, just think about Netflix over the years. And this is me saying this. This was not on the call, but I promise you this is what's going to happen. The average revenue per user is going to climb. And I think we're going to see that over the next few years, because what's going to happen is one of two things, if not both, or a combination of the two. Number one is that the subscription fees for Disney Plus will continue to increase. not just here in the States, not just in the UK or places or anywhere in North America like Canada, South American countries. It's going to be everywhere. Everywhere it's going to go up. It's going to increase. Now, it's going to increase incrementally according to the market. I'm not saying that Indian Hotstar is going to see price increases from 75 cents a month to $5 a month or $10 a month. That's not going to happen. They do have some higher level subscription services, but their highest level is still only about $20, $25 a year. It's not much. It's still a fraction of what we have. However, we are also going to see probably increased advertising content. And this is the thing that I would warn or caution or just at least inform people here in the States, just like HBO Max recently did, where they introduced a $10 a month subscription fee service that has ads in it. Okay, because you don't have to pay $15 a month. You can pay $9.99 a month if you want to, but you're going to get ads. I'm almost positive we're going to see Disney Plus at some point go into that route, where we'll see the current subscription fees of $8 to $9 a month probably reach the $12, $13, $14, $15 a month threshold over the course of maybe the next 5 to 10 years. And then a new level of subscription will be introduced probably right around where we are now at $8.99, but with ads. So don't be at all surprised to see we're eventually going to get to that point. Again, it's not going to happen 6 months from now or next year. It's going to take several years. It's going to be a slow climb. But I'm sure they are not doing that now as much as they would want to, because they're not delivering the new content that they want to deliver to basically cushion the blow of increasing fees or adding advertising or things like this. This is all the kind of things that go on behind the scenes, generally speaking, with this. But a few things in this report, and I don't want to go through a bunch of details on this because we've already gone long enough, but I want to call it to your attention because I think it's important to realize. And that is, some of the segment results. The parks and whatnot for Disney, of course, are still in recovery mode. They're doing very well, although they're still not at quite the points they were at pre-pandemic. They're still dealing with things, in California. They're still dealing with things in Euro Disney. They're still dealing with things with the Disney parks, obviously, in China. These are all things that they still have to work through. But in terms of where they are on the timeline to get back, I think they're pretty well there. I know it was reported that a lot of their resorts, their bookings for the cruise ships, for some of the high-level resorts, like this new $5,000 a weekend Star Wars resort that they're building in Florida, is booked out. They're almost at full capacity, booked out for quite a bit, a very long time. So that was a win. A lot of people like to look at Chapek and say, well, how come he's charging this much? Simple, because there's people out there willing to pay it. I mean, he's doing what any good CEO would do. He recognizes there's a market for it, and he's recognizing that, yes, there's enough people out there, obviously, that are willing to pay these much higher prices to get in early and be some of the first people to see these things. And then eventually you'll probably see the prices come down a little bit, or at least at some points of the year, once they feel like they've exhausted that capacity to get those kind of prices. And again, that's not terribly uncommon. It's something that any good, smart CEO would do. If somebody's willing to pay you that much money for a product or service, then it's worth that much. I mean, that's what it's worth. But I want to talk about one thing real quick here, and I think it's interesting to bring up. I'm probably not going to find it on here. I have a printed copy of this same report with me, so I'm going to be reading from this if you just give me a moment. But if you look here, Disney Media and Entertainment Distribution, linear networks, that's television. That's ABC, that's ESPN. You got to remember Disney owns a lot of sports contracts, and they're only getting more and more and more of them. So that is a cash cow for Disney. And then you look here, direct-to-consumer. Direct-to-consumer, just so everybody knows, that is Disney Plus. Now, of course, direct-to-consumer didn't have too bad of a quarter. They're still, and look, I make this very clear. Disney Plus, according to this report, they are still operating at a loss. Still operating at a loss. They're not making money on Disney Plus yet. And a lot of that is because of the amount of production that goes into that. Chapek, I know last year talked about they've committed nearly $10 billion to Disney Plus just to produce content. Now, that's on a global scale. That's not just content for here in the U.S. And he's upping that number now, although I can't remember what it was, but they've committed to even more because they can see the growth is on pace with what they want. It's still really ahead of pace of what they want. And they want to make sure that they capture and captivate and hang on to that audience that they have created there, okay? And I know some of us can complain about some of the stuff on Disney+. I wasn't a fan of Loki, wasn't a fan of WandaVision, wasn't a fan of Falcon and the Winter Soldier. I thought they were all crap by and large. But again, you got to remember that Disney Plus and the services that they're providing are a lot more. You know, Marvel is just a little piece. Star Wars is just a little piece. And it's you know, they're trying to grow that and expand it, and we can have the pop culture discussion on things like Favreau and Kennedy and Star Wars in another video, which we have done, but I'm trying not to do that here because that's not what this is about. This is just pure numbers for right now. But one of the things I want to call your attention to is, and I'll probably not be able to find it on the website, but I did highlight it here because I'm going to leave you with this. Theatrical releases. Okay, we just got through the fourth fiscal quarter, and I have this section you can see highlighted here. This is in the report that is on the screen. Again, anybody can go read this. I encourage you to do so. Content sales, licensing, and other. Content sales, licensing, and other revenues for the quarter increased 9% to $2 billion, and segment operating results decreased from an income of $86 million to a loss of $65 million. The decrease in operating results was due to lower theatrical and TV SVOD, that's streaming video on demand, distribution results. The decrease in theatrical distribution results was due to a higher operating loss, listen to this, from titles in release and increased marketing expense for future releases. I'll explain that in a minute. Jungle Cruise, Shang-Chi and Legend of the Ten Rings, Free Guy, and Black Widow were released in the current quarter, whereas prior year quarter included the New Mutants. That was about it. The company incurs significant marketing costs before and throughout the theatrical release, which may result in a loss during theatrical distribution. So let's break that down a little bit, because what was still to this day my most popular video here, Shang-Chi was a fail. I told you that Shang-Chi lost money. Well, that division lost money this quarter. It's right there. It's in the report. Now, they don't break it down movie by movie, obviously, which is fine. And I can't use this to say that, oh, this absolutely definitively proves that, no, I'm not saying that. And I want to make that very clear. What I am saying is that division did not do well. Now, with Black Widow, of course, they raked in about $380 million in theatrical distribution. That was gross revenues to the theaters. That wasn't what Disney took home. Disney takes home roughly half of that or so, okay? Same thing with Shang-Chi. Shang-Chi's at about 430 right now. They take home about half of that, right? So they get to walk home with about $215 million. And again, what have I talked about? And they talk about it in here with marketing. I'll read it again. The company incurs significant marketing costs before and throughout the theatrical release, meaning that even though they produce a movie for $150 million like Shang-Chi, they're still spending money in the weeks leading up to it to market it, to get people into the theaters, and then they spend even more money after it gets released to get people to continue to coming into the theaters to see it over the first 30 days or so of its run. Now, what they probably would not have spent much money on marketing yet at this point is the Eternals. We're not going to see what the Eternals really meant to Disney, although we never get a full breakdown, but we can make very, very, very educated guesses. And then we will have Deadline, usually at the end of the year, likes to do their blockbuster reports, and we'll have some numbers on that, and we'll talk about that probably early 2022 whenever Deadline produces that. If they do it again this year. Hopefully they will. Let me put it this way, they did it in 2019. I can tell you that for sure. But they probably would not have spent much money on the Eternals yet in terms of marketing, because by the time this fiscal quarter closed on September 30th, we were still more than 30 days out from the Eternals releasing. So probably very little of the marketing budget had yet been spent, at least in terms of putting things on online ads or television ads or anything like that. So the money here was really spent on these things. And as far as the Disney Plus revenues for Black Widow, which we know, according to Disney in the ScarJo lawsuit, was around $125 million of what they got in Premier Access money, that was reported under the DTC portion, which was the direct-to-consumer. That's the Disney Plus numbers. They did not show up here in the theatrical distribution numbers. So point being is that, we have to look at it, and yes, we can say that these movies did great post-pandemic, that they broke a post-pandemic record or whatever, and that's all fine and good. I'm not going to argue that, and I never have. But what I have tried to offer to folks out there watching is to understand that all that's well and good, but that's just marketing buzz. That is to get more people in the theaters. When it comes to whether or not the movie actually produced a profitable result for, in this case, Disney, that means neither here nor there. That means nothing. And the proof's in the pudding here, where we've got this quarterly report from Disney and the theatrical distribution. It lost money this quarter. Now, I know Jungle Cruise, did not do well in the theaters, and Black Widow obviously had a lot of its money shunted to Disney+, but you still had Shang-Chi, you still had, Free Guy actually did pretty well considering what it was, and again, that was an inherited title from Fox. That was from the Fox deal. That was not Disney coming out of pocket and spending whatever that, I don't know what the budget for that movie was, but I want to say it was around $100 million, maybe $150 at most. But that was not Disney coming out of pocket for that. That was, in a sense, it was all just pure profit for Disney, because that was part of the multi-billion-dollar deal they bought with bought Fox Studios out with. So really, that's it. This one's going on a little bit longer than I'd hoped, but I wanted to try to give you as much information as possible. And certainly, there's a lot of things in this report that I didn't cover, because I could sit here for probably an hour or two talking about this stuff. But needless to say, while I know there's a lot of people out there, including some friends of mine on YouTube, that look at this and think that this is doom and gloom for Disney. And in the short term right now, it seems like it might be, but I'm going to tell you right now, this is not going to last long, folks. I don't look at what's happening today, tomorrow, next week. I'm looking at down the road is I want to see what Disney has by this time next year. This is the end of fiscal 21 on September 30th this year. I want to see what they look like end of fiscal 22, because again, Bob Chapek, he's really only had the reins by himself to this point as CEO for 3/4 of this one fiscal year. And in fact, Bob Iger's still there as executive chairman. He'll be retiring at the end of this year, December 31st, end of this calendar year. So really next year, right now, we're in the time when Chapek is really going to be in full command. And of course, big ships like Disney take a while to turn. I always ask everybody to be patient. Just because somebody new walks into the big seat, it doesn't mean that Tuesday everything's going to turn around and change. By the time we see things like the content they're producing, as Chapek has many times talked about, Disney is moving back to a distribution-focused model of business, meaning they want the salesman to be able to sell a product, and the type of products that they build are going to be determined by what people want to buy. They are not just going to let content creators produce whatever they want and then stick it on the distribution department and force them to just go sell a hot turd if that's what it is. And I think that's a very smart move by Chapek, and it's something that Iger probably didn't like, because he made public comments about, boy, I hope they don't let all the math and the numbers, squash creativity. Well, to some extent, I'm sorry, you need to. And we've seen the reality of this when they make certain films based around nonsense that nobody wants to see, hint, hint, Eternals, and the numbers just don't bear it out. And Disney's theatrical releases, obviously, since Black Widow, have been on steady declines, especially when you factor in the alternate revenue sources that were concurrent, like with Black Widow on the Premier Access, which is why I said with Black Widow's primary release, they really raked in about a theatrical equivalent of $550 million. Shang-Chi's at $430, and at this point, Eternals looks like it's going to come in less than Shang-Chi and maybe substantially less, which with a $50 million higher production budget, that is bad news for Disney. I'll be quite honest with you. I don't expect to see the theatrical distribution department really turn any kind of profit in the fourth quarter, which I will add that part of this is also Disney is no longer licensing out as much content to other networks and TV stations because they're starting to bring all of this home into Disney+. Anyway, just keep an eye out. Disney really doesn't have another big title. I don't think before the end of the year they might, but I can't think of what it is right now. If some of you out there are saying Spider-Man, sorry, that's not Disney. That is Sony. Spider-Man the movie rights are fully owned by Sony. Sony has those rights. Those rights are theirs. Those movies are made. Those movies are distributed all by Sony Pictures. Marvel is sharing a little piece of that pie right now because of the allowed crossover with the MCU. But that is a Sony film, and that is why Spider-Man is going to wind up being in China. Mark my words. And the Marvel stuff can't get into China. It's kind of funny, isn't it? Any case, want to hear from you. Leave some thoughts and comments below. This was a mouthful. Hope you guys stuck around for it. I know this stuff can get a little bit boring, but I hope it was at least informative and you learned a little bit today. And I want to hear from you. Make sure you hit that like and subscribe button. Share this video out. And until next time, take care.